mode.
Welcome to our 2017 webinar series. This year's theme is Creative Solutions, Our Concepts, Your Clients. Each month we'll focus on stories of your clients spanning through various generations. We'll explore plans for your professionals starting on their careers, newlyweds and growing families, small business owners, and soon-to-be retirees. We'll show you how we carefully crafted risk management strategies to help your clients enjoy life in the moment. This month, we'll explore the benefits of low-load life insurance and annuities. Each month's series will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar will be recorded and will be posted on our website within a week in case you missed it. And throughout 2017, loyal fans will receive 9 CFP CE credits, 1 for each month. Today's presenter is knowledgeable in a wide range of solutions here at LLIS. He's constantly monitoring their insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. He joined LLIS in 2003 with his CFP and MBA, and has been writing the LLIS story as president and CEO since 2013. And here is Mark Maurer.
Thank you, Claudia, and hi, everybody. I hope you all are having a good start to your August. Here in Tampa, it is warm, and it's going to be warm. And there's nothing I can do about that. I knew what I got into when I moved here. But hopefully it's nice and where you might be. And today, I wanted to talk about low-load policies and what they can do. And this is going to be, forewarning, just a little bit drier than some of our other presentations because it deals with sort of the design of different types of policies. It goes into sort of the mechanics of some policies and sometimes more numbers than other policies or other presentations we talk about. So I hope it's still interesting. I just may not have as many fun things to talk about, but I think it's really interesting, and it's really something neat that I think fee-only advisors can use, take away, help their clients a lot, because it's something that the average financial planner out there doesn't have access to it. It's another thing besides all the different things you do being a fee-only planner that can set you apart. So what are we not going to talk about? Well, about once a year, I get a call from somebody who is hauling not a full semi-truck full. It's usually a small load, and so they call looking for every once in a while a low load insurance policy because they want to insure this not full semi-truck when they're driving from Chattanooga to Birmingham. And so about once a year I have to explain sort of what we do, that it's life insurance, not for shipping insurance. And these people are very nice, fun to talk to, but that's not what we're going to talk about. What are we going to talk about? Low load policies are available on permanent life insurance policies and annuities. So things that generally have cash value, designed to have a cash value. Annuities, immediate annuities don't have a cash value, but have some sort of, usually with the immediate annuities, it's a big upfront component. So it's not term insurance. It's not long-term care insurance. It's not disability insurance. For the most part, annuities are permanent life insurance, things that have cash value or cash value components. So that's what we're going to talk about. What makes one of these policies a low load policy? Or I think a better way to ask the question is, what normally goes into building a permanent life insurance policy or an annuity? Well, let's look at a traditional commissioned permanent life insurance policy there on the right. At the very bottom, you have 10%, and these are just round estimates, ballpark numbers, 10% for home office expenses. The insurance company they have expenses for issuing policies. There's another 10% for marketing, and that's for home office or insurance company people. You have your regional VPs, you have people who are going out to talk to agents to say why their particular brand of policy is so fantastic. And so you have those two that are sort of the home office expenses built into it. But an insurance company doesn't really sell insurance policies. Insurance companies use an agency system, so you have to compensate the agents somehow in order for them to recommend that particular insurance company's policies. So the first thing we see there, going from the bottom up, or the third thing, is 55% of that first year premium typically goes to commissions. So commission to the agent who recommended that policy, sold that policy to a client. And then on top of that, there's another 40%, and we'll call it bonuses. This could be something that goes to a general agent. A lot of agents sort of out on their own may go through a general agent in the Tampa area or the Birmingham area, who sort of manages a bunch of other agents. So there's some bonuses or excess that sort of go to the person above that agent. There's other benefits for training, benefits if you can, as an agent, maybe you can buy into their health insurance program or long-term disability program. 18%, again, branch office expenses. A lot of the older career agency insurance companies had an office in town. Probably you can think of one, a State Farm. A lot of the property and casualty, I'm sure we all probably drive by an Allstate or State Farm, building somewhere. So the insurance company is paying to have an office there to make sure that there's somebody in that location. All of these different things built in, about 150% of the first year premium. So obviously you can't necessarily recoup 150% of what you paid out by only collecting 100. And so there's different things that are built in. Surrender charges usually are built into policies so that if somebody changes their mind later, even though the insurance company has their own expenses, what's paid out to other people, then you have all of this, more has been paid out, and so you have surrender charges if the client changes their mind. Now, compared to a low load policy, you have the home office expense. Again, the home office is, the insurance company has to exist. They have to have staff there to have actuaries, policy issue people. And then you have the marketing. And in this scenario, a low load policy, that marketing, rather than having regional VPs who talk to agents and get agents to sell policies, the marketing then is what is paid to someone like us to get policies to fee-only advisors and their clients. It's how do the home office is that built in, you have to have that to have an insurance company. The marketing is how do you get the policies to somebody? When you don't build in all the other commissions and things, it's a lot more efficient. And right below that, we take a look at the fixed and immediate annuity compensation. Traditionally, 1% on a low load immediate annuity or deferred annuity compared to 3% on a traditional immediate annuity or fixed deferred annuity. So what you don't see is that this makes a big difference in the performance of a policy long term, and we're going to go into that. So like a hot air balloon, when you take out all of the loads, see our little guy there with all those money bags, the more of those loads and things you have, the hot air balloon isn't going to fly as high. But when you can throw out commissions or some of the other things, the benefits, the branch office expenses, and cut it down to sort of the nuts and bolts of the policy, that hot air balloon is going to go higher. It's going to work better. So we're going to talk about some low-load life insurance options, low-load deferred annuity options, and low-load immediate annuity options. So let's talk about life insurance first. First scenario I'm going to talk about is using life insurance for accumulation. Cash values accumulate on a tax-deferred basis, and that's sort of been true since the beginning of time on permanent life insurance policies, and that's one really neat benefit to permanent life insurance plans. So cash values accumulate on a tax-deferred basis, and it's under the umbrella of life insurance. The IRS and all the powers that be have said that life insurance is still a social good. And so if someone dies or passes away having life insurance, then the life insurance goes income tax free. And if you structure it properly, it can be estate tax free, but at least on an income tax free basis, it still goes and passes income tax free. So you can have your cash value and accumulate it, maybe take money out along the way. We'll touch on that in a second. But if somebody dies having this policy, then there's this income tax-free life insurance. However, there's no such thing as a free lunch because there are costs to the life insurance. I'm going to touch on this here in just a minute, but sometimes we see proposals for your clients that you send to me. Single person, no dependents, no fiance, no partner, no anything, really someone who has little to no reason for life insurance. My question is, who has a loss at their death? If there's no one who has a loss at their death, then this, I don't think, is really an appropriate thing to do because you are paying for the cost of insurance. Like I said, there's no free lunch. At the very basics, how does a life insurance policy work? Universal life insurance policy for accumulation. On the left-hand side, you put in premiums. That's the check you write every year. And every year, there are mortality and expenses that come out in a little drip every month. And in that water in there, the bucket that's in there, you're also going to earn some interest on the cash values, the premiums that you put in. So if we look on it, if somebody's paying a monthly premium, every month you put in a premium, every month you earn some interest, every month some charges come out. The fewer premiums you have, you can fund this bucket just so that the premiums interest cover that drip every month. And it's going to look something like a term policy. It may stay level for a few years and then you have to increase it every year. What we're going to talk about is a way to accumulate for your client where you're putting in the maximum premiums. So you're filling the bucket as quickly as possible. And so you're earning the most interest as possible inside the policy, but the mortality and expenses are still a drip. So if I have still just a drip and quite a bit of interest, then it's doing what I want it to do for accumulation purposes. So Marty C. is a client of a fee-only advisor, came to us a few months ago. Marty C., he has legacy goals and desires. He has some kids. So right away, life insurance is a good option for him to consider. He has 5 or 6 years left of work, has no debt, so not another place that he'd be possibly better off putting money. Maximizing qualified plans, again, there's not anything that we're sort of missing out on. And his advisor is asking for another tax-deferred vehicle. So that's what they're looking for. So advisor and I started talking, had heard about this, about the low-load policies to accumulate, so started talking with me. So the first thing I asked is, does he have any beneficiaries? Now here's some famous people who, as far as I know, don't have any beneficiaries. no kids, no direct descendants where you would say somebody has a loss at their death. Now, they might want life insurance to pass on to a charity. I don't know, maybe the Catholic Church might be one there, but not necessarily what I consider a need for life insurance as a way to pass money on to kids or beneficiaries. So that's sort of the first question. Are there beneficiaries? Marty, yes. So when we look at universal life, and this is sort of true for any permanent life insurance policy, when you look at permanent life insurance as an asset class, the value of it at death is inversely correlated to the amount of time you have. Now, my wife's the math teacher. I think I used my words right there. But what it means to say is that if I have a life insurance policy and I pay 1 year of premium, call it $10,000, and I die and somebody gets $1 million, that is an amazing rate of return. On an investment, if I put in $10,000 and if I have $1 million in 1 year at my death, it was probably illegal. But you see the point. Usually on an investment, I'm happy if I earn 8, 10%, whatever it might be. So it takes me a long time for that to turn into $1 million. With life insurance, my rate of return at death is the highest right away. So as you start to see more and more things where you hear about life insurance as an asset class, the reason that it can work really well is that it has if you don't have enough time for investments, things to grow, then life insurance is a great way to protect against that. Because at death, life insurance is when it has its highest value. Why universal life? Universal life is what I recommend because it's a flexible premium. So you have whole life policies, which are a form of permanent life insurance, but it is a fixed premium contract. So for $1 million, and again, you can design little things here and there, but for the most part, $1 million policy is going to have a specific premium that has to be paid. With universal life policies, you can choose to max fund it over 5 years, pay it over 20 years. You have the option to potentially miss a premium if things happen. Pay some for 3 years, pay a higher premium in the 4th year. So it's more flexible, especially when we're looking at things like accumulation, where we're looking at not necessarily wanting to have to put in X amount every year, but hoping that we can and assuming that we can. And with life insurance, it is tax-deferred growth. It is not tax-free growth. And sometimes I have heard using life insurance as a Roth IRA lookalike. Always makes me nervous to compare anything to a qualified plan. The difference is that with a Roth IRA, the growth is actually truly tax-free. With life insurance, the growth is tax-deferred. There are some neat ways you can structure it so that you may not pay tax on when you take money out, but it's just tax-deferred, not truly tax-free. And I have one question. Is there a maximum you can put into a universal life insurance policy? Can you put in more than the death benefit amount? Great question. I'm about to touch on that. The answer is you can't put in more than the death benefit amount. And good question. I'm going to touch on that here in just a second. So with the universal life policy, you have the option to take tax-free withdrawals up to your cost basis. The IRS, while not magnanimous, they're somewhat reasonable and say you've paid in $50,000 of your own after-tax money. You have the ability to take out $50,000. We're not going to tax you again on something that you've already paid tax on. So you can take tax-free withdrawals. A benefit to the low load policies is that they don't have any surrender charges. Normal commissioned policies have anywhere from a 10-year surrender charge to, if you look at some of the indexed ULs, 19 or 20 years of surrender charges. So even though you could take out your basis tax-free, you may have a penalty for a number of years if you try to do that. So with the low load policies, no surrender charges, so you have immediate access to those cash values. So first thing you could do when you want to take money out is take out tax-free withdrawals. And when your cost basis is exhausted, waiting for the laughs, can't hear them. This made me chuckle every time I see it. So when your cost basis is exhausted, then you can take tax-free loans against the cash value. So you would take out your cost basis first, all your, thank you to everybody who liked my joke. So once you've taken out your tax-free cost basis, then you can take tax-free loans against the remainder of the cash values. So in this case, we're taking loans against what are essentially gains in the policy. And a number of different, there's the dog picture. One or two people said, can you leave it on the dog picture just for one more second? All right. I've taken out my cost basis and withdrawals. Now I can take tax-free loans. And most insurance companies have a preferred loan rate. I review policies regularly where the policy loan rate is stated at 8%. Cash values on life insurance policies, a whole life, a UL, whatever it might be, are not earning 8%. So someone is taking a loan at 8%, they're earning less than that inside the policy, so it's costing them something to take these loans. A number of policies, or most policies, some policies, after a period of time, it's usually after about 5 years, you get a preferred loan rate. And usually it says that the loan interest rate will be, I'll make it up, 4% for the first 10 years and then 3% after 10 years. You'll also a lot of times get anything you put into a loan gets charged a different interest rate. So it may only earn 3%. So what ends up happening is if I take a $20,000 loan in year 9, I am charged 4% on the loan, but I earn 3% on that loan balance. In year 10, the loan interest was 3%, the loan charge was 3%. So really, there's not really much of a cost after a period of time to take out some of these preferred loans, unless the policy is a MEC. This is probably the biggest part of this, and MEC is a scary word a lot of times. I think sometimes it matters, many times it doesn't, but for accumulation purposes, it really does matter. So in 1986, the Tax Reform Act got rid of almost every known tax shelter, almost every one that was known. But like fee-only advisors, insurance agents are creative and realized that there was one out there that wasn't as complicated as some of the tax shelters they were building. It's whole life insurance. And so what we were able to do, and I mean people, insurance companies, 1986, you were able to overfund whole life policies. They were usually even single premium life insurance policies. And to the question earlier, these many times were putting in $90,000 into a $100,000 life insurance policy, or maybe even $95,000. You had all the great tax benefits we talked about with very little insurance, very little costs. The problem The problem was it's tax deferred, you have the tax favored withdrawals, you have the tax-free death benefit. The problem was this was too good, and it was being touted as the last great tax dodge. Going back in history, if you ever want to make the IRS look into something, call it the last great tax dodge. Because 2 years later, came out with TAMRA, the Technical and Miscellaneous Revenue Act. TAMRA, that's, neither of those are particularly exciting. But what did it do? It put a stop to that, and it defined the MEC. And so I will review policies occasionally, pre-86, pre-88, and they've been grandfathered, even though they may have been funded such that they would be a MEC if we tried to do it today. They've been grandfathered to not, automatically become one because of these rules. So what is a MEC? MEC stands for Modified Endowment Contract. And the reason the IRS came up with these is they said, people are putting in too much money. You're not using it like life insurance. You're really using it like an annuity. And so when you put in $95,000 for a $100,000 death benefit, you're really not using it for life insurance. The social goodness aspect of it isn't being met. And so we're going to limit what you can do. They created what's called the 7-pay test, which nobody really needs to know the numbers or how it's calculated. I'm not 100% sure how it's calculated either, but I do know on an illustration there is a 7-pay test based on someone's age, the amount of the policy, that says here's how much you can put in any given year into a policy in the first 7 years. And it's going to be a lot lower than what that single premium policy would be. So why sometimes is it not scary? Well, there's no difference to deferral. It's still cash value, still defer, income tax free, tax free. And at death, if you have a policy and it's a MEC or non-MEC, at death, it's still income tax free death benefit, no changes there. But the IRS said people were putting all this money in and using it to take out the tax-free withdrawals, do the tax-free loans. You were basically funding it like an annuity, but getting the benefits of life insurance. So when you fund it this heavily, we're going to treat money out like an annuity. So if you take money out, you can take withdrawals, you can take loans, but they are LIFO, taxable out first. I can't take my tax-free loans. I can't take my tax-free withdrawals first. So that's the big treatment, basically like an annuity. Exact same tax treatment as an annuity there. Same as an annuity that there's an 10% IRS penalty if I take money out pre-age 59 and a half. Like I said, basically the treatment for taking money out during life is like an annuity. So deferral, same as life insurance. At death, same as life insurance. Both are life insurance. If I take money out, then I don't want the policy to become a MEC because I've lost some of the neat tax benefits of the favored tax treatment of taking money out. But as long as the death benefit stays in force, any remaining death benefit passes income tax free to beneficiaries once I've taken money out or not. If it's a MEC, I may have paid some tax on that money I took out. If it wasn't a MEC, I didn't. But if I have $1 million and can take $300,000 in withdrawals and pass away, somebody gets $700,000 income tax free. If I have $1 million policy and I take a $300,000 loan and I pass away, the insurance company pays itself back its loan, $300,000, and returns $700,000 to the beneficiary. So Marty C. wanted to look at a $1 million low-load universal life policy. And because he has 5 years left to work, he wants to put in 5 premiums of $70,670. That's kind of an odd number. How did we come up with that? Well, because the MEC limit is $70,673. So over those 5 years, if he paid in $71,000 any one of those years, you'd think the policy would automatically become a MEC. It won't, because contractually, or not contractually, but mechanically, if Marty tried to pay a $71,000 premium in year 2, more than likely the insurance company is going to cash $70,673 of it and return him $300 and some odd. They aren't going to let him accidentally make the policy become a MEC. They may return the whole check. Normally they don't, but they may pay up to that MEC premium and return any excess to him to keep it from becoming a MEC. And what's really neat about this policy is that, like I said, there are no surrender charges, so there are no barriers to exit. Let's say after 1 year, things horribly change. Marty gets fired, doesn't have the money to make these premiums anymore. Then what does it look like a year from now? Well, if we look at our first year column or row, paid in $70,670. Current crediting on this particular policy, 4.6%. So after 1 year, he'd have $69,652. Remember what I said a little bit ago? There is no free lunch. There are some costs to having the life insurance, because if he dies in that first year, the insurance company is on the hook for the difference between the $1 million and what he's paid in premium. So they're on the hook for $900,000, a little bit more than that. So there are some costs to it. No free lunch. And then I looked on the right-hand side, what if the policy earned 4% or the minimum of 3%? If we go out to year 5, after he stopped paying premiums, paid in $353,000 at 4.6%, he'll have $371,000 at 4%. And that's assuming 4% from day one. And we know it's not there today, so almost by default, it's not going to happen that way. But let's say it goes to 3% tomorrow. Something horrible happens. It starts crediting 3% right away. After 5 years, he has a $500 gain. Policy goes to the minimum amount of insurance or minimum interest rates from day one, and he still has a gain. And then if we look out year 10, year 20, remember he only paid premiums for 5 years. So in year 20, he still paid in $353,000, and depending on interest rates, $631 to $448. I have somebody ask, is the underwriting as stringent on UL on accumulation life insurance? The answer is yes. Whether it has a no lapse guarantee, accumulation, whatever the component is there, the insurance company is on the hook for $1 million. Is it as stringent necessarily as term? Not usually, because most insurance companies have term. You may have a super preferred, a standard plus, a standard, lots of different rate classes that you're trying to fit people into, and term is still a little more spreadsheeted. So we can run term quotes with 30 or 40 different companies with a few clicks of a button. So everybody's always trying to beat somebody else by a penny or a dollar. And so sometimes the rate classes have very strict guidelines for who falls into what. But so to get a super preferred may be easier slightly on a UL than on a term, but the insurance company is still looking at, it's $1 million of risk. They're going to want a paramed exam, the application, they may order doctor's records. So all of that part is going to be similar. Now, some of you are going to have clients like Marty C, looking for other alternatives, other options to whatever they may have access to. You probably have, more of you are going to have a client like this, may even be yourself, but this is probably going to be more common as you have clients who are getting close to retirement, and they already have life insurance policies. I'm not talking about term at this point. I can talk to anybody about term and conversion if they need coverage later, but clients who already have life insurance, and then here we're meaning life insurance that already has a cash value, whether it's that whole life policy, some variable universal life policy, something with some cash value. So had this policy while they were in their working years, kept paying on it, but as we get closer and closer to retirement, clients, even you or clients, in this case I'll say clients, are looking at, I still have these premiums. I thought it was going to be done by age 65. I may need to pay it a little bit longer. I really would like to stop paying these premiums because I'm starting to look at retirement, and they were easy to pay when I had income coming in, but now that my income is going to stop, I really start paying a little more attention to what I have going out. And again, I had that variable policy that was projecting 12% in the 1980s. Have the whole life that was predicting 9% dividends, and that hasn't happened. I thought I wouldn't have to pay anymore by now. So really, I'd like to look at something guaranteed. I want to not pay any more premiums so I can stop my outflow. I want to know that there's some life insurance there for my spouse or my kids, and I just want to get it set. Like the Ronco food dehydrator guy, set it and forget it. Or was that the rotisserie? One of those. Set it and forget it. I want to know what it is, that it's going to be there, and I don't want to pay any more premiums on it. So we look at a no lapse guarantee universal life policy. And so here's one of your clients, Jerry W. He's 68. And this is very common sort of scenario, how this is going to play out. Jerry's 68. He's recently retired. He has $1.3 million of life insurance in two different universal life policies. I think one was variable and one was universal life. Cash value of about $305,000. He has a cost basis of $139,000 between the two. So he has a fairly large gain in these policies if he were to surrender them. So if he decided, I don't want any insurance and just surrendered them, he's going to have a taxable event of $170,000 this year. Not great. I guess the good news is he has a gain of $170,000. It's better than a stick in the eye. But as a way to, I really don't want to create another taxable event of $170,000 all this year. And while the policies have the gain, we asked for, and we helped the advisor and the client get new proposals. What premiums would he have to pay to keep these policies going to age 95? And he's in good health. He's in very good health. So the premiums, we need some premiums that are going to keep the policy around as long as he is. He wasn't paying this. He was paying fairly less than this, and so the policies were going to run out much sooner than his life expectancy. So he was going to need to start paying $18,000 to keep that full $1.3 million. So Jerry, like in our slide before, is looking for, in this case, he doesn't want to pay tax. He wants to know that it's guaranteed, and he doesn't want to pay premiums. Now, in order to do that, probably aren't going to be able to get the full $1.3 million because we're saying you have to pay $18,000 a year to keep that much. And that's fine. His goals are to no premiums, keep some life insurance, not create a taxable event. So we looked at a 1035 exchange. So 1035 is a section of the Internal Revenue Code. It says even if you have a gain in a policy, if you move from insurance company A to insurance company B, the cost basis transfers, the cash values, but there's no taxable event. It's kind of like an IRA to IRA rollover. Because it goes from company to company or custodian to custodian, there's no taxable event. He never actually gets it. And so his cash values were able to guarantee $959,000 for the rest of his life with the Columbus Life Advisor plus UL. It's a low-load policy designed for us to offer to fee-only financial advisors and their clients of $959,000 a year, or $959,000 death benefit. We compare it to other options out there. And so to give you an idea of how it compares to regular commission policies, here were the top 3 other comparisons. When you strip out those commissions, when you strip out, the branch office expenses, paying, insurance company paying for your rent, all of those different things, it makes the policy function better because there's less that's been taken out initially. The insurance company can use more of that 1035 exchange right away. They are using more of those cash values because they didn't pay some of it out to an agent in commissions. So the policy works better. $959,000 guaranteed compared to $736,000. So that's part 1. So if Jerry just wanted to maximize the coverage, that's what we do. But we also threw in a twist. Now remember what I said, we can take withdrawals up to your cost basis and have those be income tax free. So is the Columbus Life policy a guaranteed UL? Yes. So in this scenario, we're using the Columbus Life policy with a no lapse guarantee rider. So we're adding a twist. So as I said, we can take out our withdrawal after 1 year, or we can take tax-free withdrawals. With this policy, we can do that after a year. Has to stay in the policy has to be in force 1 year to take the money out. Another question, are these companies have comparable AM Best ratings? Yes, Columbus Life has a Comdex of 96 and AM Best of A+, so very highly rated companies. Take that withdrawal after 1 year, and we can do that because there are no surrender charges. If we come back to this policy, the cash value and the surrender value after the end of 1 year are the same. Money went in to pay for those long-term guarantees, but if we look at those 3 other companies, they all have somewhere between $20,000 and $40,000 of cash surrender charges. So if I wanted to take out $50,000, the first $40,000 is going to a surrender charge, or $20,000. So I don't have access to all of the cash value that I have right away when you have surrender charges. When you don't have surrender charges, you can access it right away. So for Jerry, he had the $959,000 policy. After 1 year, if he wanted to, he could take out a tax-free withdrawal of $139,000. And that reduces his death benefit to $544,000, still guaranteed for life. So I would say probably 50% of clients and advisors who we look at policies with gains in, maybe 60%, take that back, not 50, 60% stop at the first part. I want to maximize the coverage. I have this money here. It's what I want to do. I want to guarantee this for my spouse, my kids, whatever it is, but I know there's no more premiums. I like that part. I'd say then 40% of people then do this second part. I have some gains in the policy, but I also have some cost basis. So it's kind of a way for me to have my cake and eat it too. As you can see, Jerry's basis is proportionally pretty high. So when he takes out a little bit less than half the cash value, the death benefit goes down quite a bit. So the withdrawal to cash value to death benefit proportions are fairly proportional. So again, just something to think about. A lot of times we have the option 1. How much will it get me? $250,000, $300,000. Great. Sometimes, especially maybe with larger policies like this, there's a large gain in that policy, or large cost basis in that policy. So that comes out, and then we have like Jerry takes out his $139,000. He's laughing all the way to the piggy bank up there, leaving that $500,000 policy for his beneficiaries. Is underwriting less stringent for 1035s? No, it's exactly the same. The insurance company they're still looking at what is the death benefit. I'm liable for that. We could argue that if you're paying $10,000 a year, put in a $100,000 lump sum, it's the difference between $990,000 or $900,000 of net amount at risk, but it's still net amount at risk. So whether it's a 1035, single premium, annual premium, the insurance company's looking at the $1 million liability, and that's how they're going to underwrite for it. Let's see, there's good questions coming through. In this case, so somebody asked, what was the rate class? I believe Jerry was preferred. And so does this fall apart with any rated requirements? No. For Jerry, it would have worked exactly the same. It just wouldn't have been $900,000. It would have been less. So all of the components work exactly the same. You just end up possibly with less life insurance to start with. He can still take out that $139,000 withdrawal, but then the death benefit then would be less because we started with less because it was rated. Let's see, one more. Why does this death benefit go down to $544? Thought it was $959, less the cash value of $139. Good question. If this was a traditional universal life policy, we could take out a $139,000 withdrawal and the death benefit reduces by $139,000. So that's truly how a true withdrawal would work. As you take out $1 of cash value, you surrender $1 of death benefit. Because we wanted to keep the no lapse guarantees, which is based on a particular premium in today that was going to guarantee a death benefit for his lifetime. If we took out $139,000, the death benefit could come down $139,000 and leave whatever that is, $700 and some odd, but that no lapse guarantee rider would expire before life. And so in order to keep the no lapse guarantee, we're reducing the amount of insurance sort of proportionally, almost as if he was 1 year older. What would a single premium of what's left guarantee for his life? Hopefully that wasn't too confusing. Email me later if it was. Okay, I'm going to keep going, and there's some good questions. I will get back on here. One more just in case. Do new policies have to illustrate through 120? Thought we looked at one of the illustrations through 95. Policies, you can pay premiums to carry a policy however long you want to. If you say illustrate a premium to carry to policy maturity, then yes, most policies have anything like age 110, 115, 120, whatever the policy maturity is. You can choose to pay less to have it go to a shorter period of time. So with his existing policies, one being variable, not having the no lapse guarantee, you can pick a premium to carry for a certain number of years. So we picked age 95 to compare to. Okay. Deferred annuities. I have a few more coming through. I will, if I have time, we'll get back to those. If I don't have time during the webinar, I will get back to everybody individually. So annuities, we don't have, especially on a deferred annuity is about as simple as we can get. There's no life expectancy. There's no paramed exam. There's money that goes in, goes to the insurance company. The insurance company pays money to an agent. And then the client gets an interest rate. So there's money in, money out, and then you earn some form of interest rate on your money. So if you have less paid to the person offering the policy, less goes out of that money that went in, and so more stays in the policy. And with annuities, you have two ways of doing that. With a fixed deferred annuity, you can't really give somebody more than they put in, but you have the spread. So the insurance company is earning X percent on their giant ball of money, and they're going to return Y to the owners, to the contract owner. Built into that is what's paid out. If on a regular commission policy you pay out 3% to Ned over there on the left, or for a low load policy pay out 1%, more stays in the policy. So on a deferred annuity, what you end up with is an improvement in the interest rate. And so on the top, Integrity has some annuities. They have both a deferred annuity and an immediate annuity designed for RIAs. And the difference here is reflected in the interest rates. So on a 10-year fixed annuity, you have 4% initially and 3% years 2 through 10. And compared to all the other options, over time, that's going to return quite a bit more to the client, to the policy owner. Now, I think we might argue about whether those are particularly exciting to begin with, but proportionally, there's quite a difference. Doesn't look that necessarily when we see 3.6 to 2.6 and 4 to 3, but on a proportionally, there's a big difference. Now, I think immediate annuity sometimes can highlight it a little bit better. Money goes in, the insurance company guarantees an income stream. So James is 81, Elsie is 71. They're about to retire. They have some assets. They have their house. Besides the house, their liquid net worth is about $1.5 million. $624,000 of it is in his IRA. And so as the advisor is meeting with the client, James, he's 10 years older than Elsie. And he's told the advisor, is working with the advisor, because his stated goal is to use his IRA funds to create a legacy income guarantee for his wife. So he wants to use his IRA, not necessarily just for him, but also to make sure that there's money there that she can't outlive too. So we're going to take that, create a guaranteed income stream. With an immediate annuity, there's all kinds of different payouts. Period certain, paid just for 10 years. In this case, we want lifetime. Remember, he wants to make sure that she's taken care of for her lifetime. So we use a joint lifetime payment. So we'll pay a certain amount every month as long as one or both of them are alive. And then once we have both of them receiving that payment stream, we can add all kinds of different things. Pay for as long as one or both of us are alive, but not less than 10 years. In this case, what they wanted to look at was the joint life with cash refund. Pay an income stream for as long as both or one of us are alive. At the second person's death, if the annuity has not paid out more than we put in, return that balance to my beneficiaries. So James, Elsie, they, in this scenario, put in $300,000 of IRA money, and it's going to guarantee them an income stream for life. If they receive, James dies next year and Elsie dies in 3 years, it's paid out $100,000. Then under the cash refund, their beneficiaries are going to get the difference. They put in 3, got income of 1. Their beneficiaries will receive the cash refund balance of $200,000. So fairly easy. Personally, I like the installment refund that would just say keep paying the annuity until it's paid out a total of $300,000, but they like the cash refund. And like I said, annuities, fewest moving parts. Money in, insurance company pays compensation, what's left funds the income stream, And so if less is paid out in compensation, more is left to fund the income stream. This, I think, highlights it really well. Integrity has an RIA, a SPIA designed for RIAs that we can offer to you and your clients. And for James and Elsie, $300,000 single premium rollover from his IRA. It's hard to say RIA and IRA in the same sentence or two. From his IRA, and it would pay an income stream of $1,725 for as long as they're both alive with that cash refund option. And so we looked at a few other options. And Integrity actually has a few. They have the one that we work with them on, and it has a 1% compensation built in for us, for LLIS. Integrity also has one designed for Vanguard, and you can get a quote from them on the Vanguard website, and it says right on the Vanguard website, this pays a 2% commission compensation to Vanguard for putting there. And you can see exactly, that's the only difference. Integrity is investing money the same way, they're processing it the same way, they have the same mortality assumptions, but if you pay out 2%, there's less that goes to the client. You have the Integrity traditional immediate annuity, pays 3% to the agent. Client gets less. And then you see other companies, traditional immediate annuities. And so there you have it. I think, at least for the first three, it's the same insurance company, same assumptions. A lot of the variance in the others, I think the commission schedule is all about the same, 3%. But through all of those different things, you have different mortality assumptions, you have different options there. But those first three, everything's the same except what's paid out. And so I have a few questions about how does LLIS get paid? Well, so for that first one, then if we help you or your clients get an immediate annuity, there's that 1% compensation that's paid to us. So it's paid directly to LLIS. I'm a salaried person. All of our employees are salaried. But if we help you or a client get that annuity, that 1% goes to LLIS. For the Vanguard Hewler one, if the client purchased it through Vanguard, then Vanguard / Hewler, somebody there is sharing that 2%, so the client gets less. The Integrity under traditional, there's a 3% commission that goes to an agent, so the client gets less. So here's a really good example of, in the first scenario, there's 1% compensation built in. The LLIS would get, it has the most return of premium, or not premium, income to the client using everything where it's all pretty much exactly the same. Oh, and that's so about the income stream is about 4.8% higher when you compare to the traditional ones to the low load one. The questions are coming fast and furious here, so I think I'm hitting right about my time. So we talked about low load permanent life insurance, deferred annuities, immediate annuities, sort of how they're built, how they're designed, and able to, like on the hot air balloon, when you start throwing stuff out, if you can imagine bailing a boat, taking on water, all that extra stuff, all that extra cargo, when you start getting rid of it, it starts being more efficient. So did you know, before I get to a few more of these questions, and we are open for registration for our LLIS Insurance Academy. It is end of February on the beach, Sheridan Sand Key. We had it there last year. It was a great venue. I think people really enjoyed it, and we had a great time on the beach. It's Florida in February. You don't want to be here in August, but you want to be here in February. So later on this year, Jerry, Jill, and I will be at the XYPN conference, number of us will be at the NAPFA Fall Conference because it's just hop, skip, and a jump away in Orlando. Jerry and Jill will be at the ACP conference in San Antonio later this year. And we have a few more webinars coming up through the end of the year. Next one being September, when clients don't want to talk about death because it's Life Insurance Awareness Month. And for those of you who are new to us, we're not your competition. Our only clients are fee-only advisors. We are here, we work with insurance companies to find the best policies, the best pricing, the best fit, like the low-load universal life, deferred annuities, immediate annuities. We also work with a number of regular term insurance companies, long-term care insurance companies, disability insurance companies to find the best fit for you and your clients. So we work hard to save you time and your clients' money by doing all the research. We pre-underwrite to avoid surprises, trying to get as much information about a client ahead of time to find out what rates they really are going to qualify for. We have advisor tools and clients tools on our website. We're proud sponsors of a number of different fee-only financial planning groups, as you can see from some of the conferences we'll be at the end of the year. And Jerry and Joe just returned from the Garrett planning conference, and they said they had a great time. We have specialists in life, disability, long-term care annuities, hybrids, and we keep, if you're new to working with us, we keep you and your clients up to date through our AIM, our application information messages, keeping you up to date and in the loop so you know how things are progressing. There's not just being sent into some black hole and you're hoping that everything's going fine, as probably you did with insurance people in the past. And we are, because we only work with fee-only advisors, we've listened to advisors and clients. How can we make things faster, more efficient, more streamlined? So we've been working for at least 2 years on a new website platform for advisors, for clients. I'm so excited about this. I'm hoping it will be here soon, but it's going to do a lot of really neat things, and all of the things that we're building into it are because they're things that fee-only advisors have asked for. And I've hit my time. I have a few more questions. Some of these are sort of longer. I will see what I can do here in the short term. These are fairly complicated. Okay, one question. Assuming the $1,725 is per month on that immediate annuity, yes, so that's correct. Annually, that is $20,700. Seems a little risky for the insurance company. I think partly the fact that it's built in on an 81-year-old and a 71-year-old, that's part of it. So if you put in $300,000, divide that by the 20,000, is that 15-ish years? So they're looking at a 71-year-old may make it to 86, 87. So that's sort of how I would look at it. The rate seems, it's definitely higher, but there is a mortality assumption built into there. And because not every 81 and 70-year-old person may be in good health, then for everybody who lives exactly 16 years, if that's a life expectancy, some people live longer, some people live shorter. All right, and the rest of these look like questions there. Wondering if any of these policies have an option to withdraw part of the death benefit for long-term care, such as an accelerated benefit rider. Yes. So for a number of different policies have different accelerated benefit riders, some that you pay for, some that are built into the policy. In the particular one, the Columbus Life UL that I was looking at for Marty, it has an option to accelerate 40% of the death benefit or $250,000, whichever comes first. If you need qualify for long-term care, having a chronic illness, and there's no premium cost to having that policy, that rider on the policy. If the client does qualify at some point in time and decides to exercise that option, then that, let's say it's the $250,000, then that's almost it's not really a loan on the policy, it's like a lien against a death benefit. It doesn't impact the cash values really or anything, but it's a lien on the death benefit. And if it's a $250,000, then that earns an interest. So there's no cost to have it, but if you do choose to accelerate it, and let's say it's $250,000 and he passes away in 5 years, it'd be $250,000 he'd get today, plus 5 years of interest. I'm not great with math. Let's call it $300,000. It's the 250 has grown to 300,000. He passes away, so there's $1 million death benefit. The insurance company subtracts the lien and the lien balance of the 300,000, and beneficiaries get 700,000. Well, and thank you to all the rest of you for tuning in and listening and answering and asking questions. I will do in the next week. I will get back to everybody else who asked questions that I didn't get a chance to answer. I hope you have a great rest of your summer, and I will hopefully you'll be tuning in September. And anybody at XYPN, I will see you in a couple weeks. Thanks, everybody.